Let's talk about provision for unrealized profit, PURP. And I know that people have problems with it both in the financial reporting exam and in SBR, so I will tell you what to look out for. And if you are in my course, then you don't have to watch this very video because you have the one that is better visualized. So, first thing that we need to acknowledge is who are we dealing with? Because the situation is going to be different when we have a subsidiary and if we have an associate. If we have a subsidiary, then this means that we need to remove the total value of revenue from both revenue and cost of sales. That is because it's just left pocket, right pocket situation. So your adjustment entry is going to be debit revenue, credit cost of sales for the full value of intragroup sales. But now the question is what to adjust next. We need to adjust one balance sheet item and we need to adjust one P&L item. And we are going to look at the groups of the company who has what. So if your parent sold something to subsidiary, this means that your parent recorded profit and your subsidiary recorded inventory. This means that parent's profit will be adjusted, which means that it won't be shared with NCI. If it was subsidiary who sold to the parent, this means that subsidiary records profit, and this means that it's subsidiary's profit that will be adjusted, so it will be shared with NCI. So we are going to put this very transaction in goodwill calculation. Now, when we're going to do that, an important thing to note is that we calculate the adjustment based on closing figure. So we are going to look at the percentage of goods that remains unsold. We are going to look at the markup or margin. I have a separate video on that. What is the difference between markup and margin? But we don't look at parents' shareholding. Why? Because with a subsidiary we control everything. We control the full value of inventory, and as such, no 80%, 70% adjustment is needed. But the mistake that people make because they are not aware of is that when we are talking about this PURP adjustment that we are going to add to cost of sales, so as credit inventory, debit cost of sales, the adjustment needs to be made in order to move the opening balance adjustment to the closing balance adjustment. What does it mean? If you have this subsidiary for several years and at the start of the year, meaning at the end of the previous reporting period, you had a PURP adjustment of 100, and now you are supposed to make a PURP adjustment of 150 at the closing date, then the entry that you're going to make is just for 50. So the difference, and that is where the examiner is going to catch you, especially in the financial reporting exam. When we're talking about associates, it's totally different. So what are those differences? Number one, we don't consolidate revenue and cost of sales, so we don't need to remove the annual or this period's intragroup sale because we don't control it. Now, as for associate, we have two lines for associate. One is in the statement of financial position, which is investment in associate, and the other one is in P&L, which is profit from associate, which means that it doesn't have inventory, it doesn't have cost of sales that we would consolidate. Meaning that if the sale happened from parent to associate, then we are going to adjust parent's cost of sales. But as for associate, as it doesn't have anything on the statement of financial position except for investment in associate, that is the line that will be adjusted. That is the line that is going to be credited. Vice versa. If it's an associate that is selling to the parent, then this associate doesn't have any cost of sales. So instead, we are going to adjust profit from associate. So this is the second difference. And the third difference would be with the calculations. Because with the associate, we don't control the full value of inventory, we don't control the full value of revenue and cost of sales, we would need to multiply the PURP by our shareholding. So 20, 25, 35%, whatever is there. Once again, 3 differences between the subsidiary and the associate PURP. First, no elimination of revenue and cost of sales. Second, there is no inventory and cost of sales in respect of associate. So we would adjust investment in associate and profit from associate lines. And third, parent shareholding is going to be taken into account. And that is. So it's important to know these little things in consolidation. And if you're in my course, please make sure that you attempt those tests and look at the description, because they are designed to make sure that we pinpoint whatever you don't understand, whatever you miss there. And I will see you next. Bye.